Ladies and gentlemen, thank you for tuning in. We're here in Carlsbad, California at the Casey Research Summit on navigating the politicized economy. What a better topic we couldn't find for these times. And here with us is Rick Rule, legendary investor and fellow traveler. So Rick, for those who weren't here today, can you give the 50-cent version of your talk this morning?
Yeah, my topic was that bear markets are good, and the thesis is pretty simple. In cases where people are trying to increase their wealth, which most people are, you're better to buy goods on sale. Bull markets, by definition, are times when goods are expensive. So for people looking to increase their wealth as opposed to merely monetizing their wealth, bear markets are better than bull markets. The point I made was that of the 16 exhibitors that were here for the presentations I saw yesterday, at least, the stock charts suggested that these companies were off between 50 and 75%, while at the same time it seemed to me that 2 years of work had probably doubled most of the value of the properties in these companies. So getting goods that are twice as good for half the price would seem to me to be like an attractive proposition, and that was my talk.
Okay. Well, let's dial in on that a little bit, because we chose our topics before we came here, and lately we've seen an uptick in lots of things that have made people smile. Now, by your logic, they should be frowning. Their shopping opportunity may be going away, or not, but do you see a turn in the market, and do you think it's just a blip on the way down or lowers? Are you ready to call a bottom? How do you look at our sector?
No, my suspicion is that we're a ways from a bottom. I think certainly that the gold price has been constructive. I tell my own clients, if you think the gold price is going to go up, buy gold. Most of the gold juniors are looking for gold as opposed to having gold. And a situation where the price of something that you don't have any of goes up shouldn't be a situation that materially increases the value of your company. We buy gold stocks or gold exploration stocks because we think they're going to find gold. And while this might improve the psychology associated with the junior market, my suspicion is that this bear market has longer to last. I could be wrong, of course, but I suspect that there are a lot of factors at play. I also suspect, in terms of an immediate rebound from this market, that the need of the juniors to finance will constrain the first up move. There are a lot of companies that raised a lot of money in 2010, but then wouldn't raise more in 2011 as a consequence of soft share prices, who were disappointed to see them get softer yet, and will need to raise money. And when I say a lot, I mean 2,000 companies. And I suspect that the first leg of a bull market, if we have a general bull market in resource stocks, will be met by truly spectacular issuance, and the market will need to work through all those new issues.
Okay. So things might go down more. Can you address the potentially imminent quantitative easing? Does that not overbalance that in your mind? Or?
I don't think it does with regards to the junior stocks. I think it's a mistake to put too much big picture analysis in micro markets. My experience has been that a market is merely a facility for buying and selling fractional ownership in businesses. And the more time that I spend on markets, it seems to me, the more time I waste. Many people get information from a market, and many people try and analyze a market as a whole. From my point of view, the multiplicity of factors that go into a topic as broad as a market is so broad that it probably exceeds the capacity of most human minds, mine certainly included, to understand them. And so trying to know the unknowable seems to me to be a waste of time. Here we are today in what is arguably an ugly market for most investors. Yet, when you have a discovery, Gold Quest comes to mind.
Right.
6 cents to $1.50, $1.60. Reservoir Minerals, 30 cents to $3. Africa Oil, 80 cents to $8. This is a market that will reward a discovery. The market's not as bad as you think. What it points out to me is that a market is merely a facility for buying and selling fractional ownership in businesses, and you need to pay attention to the businesses, not the market. My hope is that this bear market lasts for another 2 years, and that this financing cycle lasts for another 2 years. We have a lot of cash to deploy, and we haven't been able to deploy that cash in this market yet on terms that resemble the terms that we enjoyed in the 1998 to 2002 bear market. So right. Maybe I'm talking my book, but I'm hoping that this bad market continues for at least 18 months.
from your side as a loan shark to the industry. You want to see more blood in the water, I get that. What you're saying, I guess more broadly, is you just haven't seen capitulation yet. You know, prices are down, people are depressed, but they're still hanging on to some hope that somehow they'll be able to finance on better terms than you want to see.
Correct. And I am, in fact, speaking as a financier, not as an agent financier, but rather as a principal financier, someone who uses his own money. I am not looking for spectacular pricing. I'm looking at fair pricing. In the junior market, the expectation on each individual investment is failure. The headline math is that between 1 in 3,000 and 1 in 5,000 mineralized anomalies becomes a mine. So when you get in the business, you're taking a 1 in 3,000 to 1 in 5,000 chance of succeeding. Now, of course, you can narrow those odds by backing better people, by getting involved in plays where you have the third dimension, a drill hole. There are ways that you can address the odds. But the fact is still that your winning trades will be less numerous than your losing trades. So the amount of money that you make on your winning trades has to amortize your losers. And you know, and I know, that the best way that you do that is by private placement investing and getting a warrant being the right but not the obligation to take advantage of a successful effort. And the particular point I'm making with regards to this financing cycle is that we haven't yet entered a period where the companies are generous enough with regards to the warrants to make it worth your while to take that 1 in 3,000 chance of succeeding.
Right. That's the fair pricing. If you're looking at the odds,
correct,
then I get it. Okay. It wasn't a criticism.
I understand perfectly.
We're just asking.
Perfectly.
Okay. So, but for most people who don't have the wherewithal to get in on all the private placements and cast as broad a net, say, as Doug Casey, to capture more of these 50 baggers and so on, they want to try to pick the winners, the people who are going to make a discovery. And you and I both know that you really can't do that. The best of the guys can spend 10 years out there and not find anything. And other people can stumble on something they didn't really deserve to find, but they did. So if you only can buy a couple companies, the odds are really not in your favor, which pushes people more in the development direction because they've already made the discovery. And then it's about de-risking and the buyout perhaps, or production, which produces a very predictable ramp up in share prices. But now we have a market that doesn't want to finance development. Any thoughts on that?
Well, Lou, you've made so many points there. It's a smorgasbord to respond to. So, and I'm old enough that I can't remember all the points you made. So let's take them in reverse order. First of all, with regards to development, there are not that many projects out there that seem to me to offer really, really, really good economics. I would suspect that there's 20. 20 is plenty for most people. The really good development stories can be financed, even in this market. The companies are leery about financing because they believe, rightly by the way, that they're selling at extreme discounts to what they're worth. In my speech, I talked about what I call my screening criterion for developmental stage takeovers. We look for extraordinary discounts to the net asset values, the preliminary net asset values established in preliminary economic assessment. In particular, we're looking for projects in PEA where the net asset value is greater than the sum of the enterprise value and the front-end capital costs. It's very rare when developmental opportunities are that cheap in the market. We're looking for internal rates of return above 30%. Looking for internal rates of return above 30% when the money market interest rate is 25 basis points tells you something about the positive carry in this market. And we're looking for payback periods in the 3-year range. We have identified several of those, and it's very, very, very rare to have that type of opportunity, and very, very, very attractive. That type of opportunity does not give investors the ability to make 10 times their money, but it does give investors the ability to double or triple their money in the 2 or 3 year time frame. And it gives them the ability to do better than that if they get help from the commodity price. I don't buy these things in anticipation of getting help from the commodity price. I want that to be the icing on the cake. Right. I want it for free. You know, I don't bake it into my assessment. I always use the forward strip in terms of my assessment. But you and I have both experienced markets where, in addition to making the right technical decision, with regards to the development status of a project, we also got helped by the commodity price, and that of course makes it much more fun.
So when somebody makes it past your filters, given the return, at that point you're not worried about whether or not the majors are buying them or why haven't they been taken out. You're saying this works, this will be financed one way or the other.
What I have learned, and this isn't a hard and fast rule, it's just a probability. Mm-hmm. It's fun talking to you about probabilities because with your math background you understand them. What I have learned is that the discounts are greatest when the preliminary economic assessment comes out. It's a third-party document, which is helpful, but it is, as its name suggests, preliminary. Mm-hmm. The pre-feasibility study is a better document, and that often narrows the gap. But the thing that unlocks the value is the bankable feasibility study. It locks or unlocks the value in two separate ways. It's a much more thorough document, of course. It's also a third-party document. It might be right, it might be wrong, you know, like any study. Right. But what's important about it is it gives legal cover to the independent directors of the acquiring party. If a mistake is made, they can say, I didn't make the mistake. AMEC made the mistake, right, or SRK made the mistake. Right. And so the arbitrage really that I see in development is between the value established in the preliminary economic assessment and the value established by the bankable feasibility study. The bankable feasibility study may precede by 90 or 120 days the first takeover interest. You remember a stock that we were both familiar with, Canplatz. Mm-hmm. Canplatz sold at a substantial discount to the obvious value of the deposit. And it did for 2.5 years or 3 years. And clients would say to me, this is the most boring stock I've ever owned. It went from $1 to $1.25 to $1.10 to $1.40 to $1.10 to $1.30. The bankable feasibility study came out and I went out with a 5 in front of it. And we're going to have those types of moves in this market too. It's just that customers, clients, investors are going to have to wrap their heads around waiting for 2 or 3 years. People want something to happen within a quarter. People confuse what they want with a goal. It's not a rational expectation.
That's right, that's right. So, okay, so people, if they were coming into the markets now, would you tell them to sit on cash and wait for lower prices? Or how does a newbie begin to?
I think you spend some money now. I think, first of all, personally, I think that the gold price likely continues to go up. For people who agree with me, I think those people should buy some gold. Whether they buy physical gold, whether they buy a paper proxy for gold like our Sprott gold or silver trusts, however they want to do it, I think people should buy some gold and silver. I think that's an important thing to do. I think that the broad opportunities in the junior sector, where you can spend money now, are precisely these development stage projects where you have a preliminary economic assessment out. And it's very, very, very important, I think, that you focus on companies where the project is economic enough that it'll be financially accretive to the acquirer. In other words, look less in terms of leverage to gold and look more for financial accretion, because I think those projects are the ones that are going to go first. And I think they're attractive right now in this market. I don't think that people need to wait for financings. The second broad area of opportunity that I see is there are some deeply undervalued commodities where the price of the commodity has to go up or there won't be any more supply, where the industry cost structure is underwater. They're producing the commodity for more than they're selling it for.
Like uranium.
And over time, that's worked very well for me. Uranium's a classic example. To bring on substantial new projects in uranium, which we have to do to keep the lights on on a global basis, we need $80 or $85 a pound. The spot market for uranium is $50 a pound. It's easy to understand why it is. Fukushima. We took 25 million pounds of systemic demand out of the market from Japan, and the Japanese reactors that were shut down sold 15 million pounds of uranium onto the market to generate cash, to stay alive when they couldn't sell power. So we had a market that collapsed from an identifiable event. Japanese power costs now, the cost to produce power, I mean, not the retail consumer's costs, are 2.5 times what they were before Fukushima. So the idea that the Japanese economy is going to run on liquefied natural gas 5 years from now or 6 years from now is laughable. The Japanese, like everybody else, in the summer want air conditioning. When they walk into a building, hit the switch, they want the lights to go on. So certainly uranium is an undervalued commodity. Certainly, North American natural gas is an undervalued commodity. The base metals prices are not underwater. The margins are good, but you can't finance a base metals project right now because of a seize up in the banking climate. So my suspicion is that some of the higher grade porphyries that are controlled by juniors, the copper moly porphyries, are probably pretty cheap on a project basis. And buying these things or buying companies that hoard them and waiting for better times is a time-honored strategy. You've been in the business long enough to remember the money that was made, as an example, by silver standard, 72 cents to $40.
Right. Or Lumina.
Yes, it took 10 years. Lumina took 7 years. Classic example. $2 to, I don't know what it was, $40, $45.
You have to add all the separate companies
you
together.
have to add all the separate properties. I mean, this was a lot of money that was made. Paladin was a
Right.
100-bagger warehousing uranium. So that's an opportunity. And the third opportunity is plain old exploration. We're now 10 years into an exploration cycle. We've been feeding the exploration business well, attracting better and better and better people every year. You've noticed this as long as you've been in the business. And we're in a discovery cycle now, and as bad as this market is, it really truly rewards a discovery. Again, however, it's process. People confuse, if you will, excitement with process. I have been financing prospect generators for 30 years, people who generate projects and use other people's money to advance them. It's boring, but it works. Rather than a 1 in 3,000 or 1 in 5,000 chance, I have invested in 30 years in 55 prospect generators. I've participated in over 20 economic discoveries and 14 takeovers. If you think about 14 takeovers in the context of 55 starts,
better than 1 in 3,000.
That result is probably 3 standard deviations better than what you would expect in the market at large. This is really pretty simple stuff if you have the discipline to stick to it. And the prices now, the price of entry into these stocks is a quarter what it was in 2010 when we felt comfortable about doing it.
That's right. Do you ever have to fire clients? Because you keep mentioning if you have the patience, if you have the discipline. These are really big ifs in my experience. People don't.
That's a really good question. As you know, I'm a student of Pareto's law, the 80-20 rule, and there are several important things to understand about Pareto. You know, the basic thesis is that 20% of a population base generates 80% of the utility in any given task. What's important to know about that is 2 things. There's another 20% of the same population base that generates 80% of the disutility. In other words, it's a bell-shaped curve. The second thing that's important, the lip, the good 20 and the bad 20, if the population base is large enough, if you run them through the performance dispersal curve again, they conformably align again, which means that 20% of the 20 generates 80% of the 80, or 4% of the population generates 65% of the utility. A different 4% generates 65% of the disutility. We ask our brokers to, how can I say this, arrange for transfers out of 5% of their customers a year. If there are customers that we don't communicate with well enough that we adequately suit their needs, if there are people who don't like what we do, who are hostile to us, we would prefer that they become customers of Raymond James or Schwab or Interactive Brokers. We would like, rather than wasting 65% of our time with the worst 5% of our clients, to shift that time to better serving those customers with whom we communicate well. So yes, we fire clients.
Okay. Let me rewind for just a moment back to commodities. You talked about some of the juniors with large base metal discoveries. So are you not concerned at all about future economic turmoil and Doug's Greater Depression and so on, slamming base metals and other industrial commodities? Or are you that patient and that long-term view that you don't care whether things go down from here before they go up?
I am somewhere in between. One of the things that I've noticed in 30 years of paying attention is that in frontier and emerging markets, there is a gradual halting political liberalization. Certainly they backslide. But as a class, people in frontier and emerging markets have become better educated and more free for the last 30 years. And one of the things I've noticed that's really surprised me is if you make somebody a little more free, you can make them a lot more rich. And I have noticed an incredible improvement in living standards at the bottom of the demographic pyramid on a global basis worldwide. And I don't see people being able to stop that. And so I see increasing demand per capita for commodities, over 3 billion capitas at the bottom of the demographic pyramid. And I've witnessed it with my own eyes, as I think you have too.
Right.
I would be in places in southern Mexico 25 years ago where people were living in adobe huts with thatch roofs, and now they're living in cinder block huts with metal roofs. Families that the kids didn't have shoes, families that were existing on 1,500 calories per person per day, that now have 2,200 or 2,300 calories per person per day, where the kids do have shoes. This is, there's an incredible latent demand for commodities. So I see a shifting in the commodity markets from the sclerotic societies like ours to more dynamic societies, or bluntly, from societies that are becoming less free to societies that are becoming more free. And so while I agree with Doug's thesis with regards to the world's mouths, Western Europe and the United States, I have substantial faith in people in, you know, places like Nigeria and Bangladesh and to some degree Brazil, places where people are becoming a little more free and taking a little more responsibility for themselves and their family, becoming a lot more rich in the context of that. And I don't think that changes. The second thing is that if you are a speculator like myself, you need to be willing to be wrong. And if I have 10 or 15% of my speculations involved in themes that turn out to be wrong, it's unfortunate, but it's par for the course. A speculator has to liken himself or herself to a very, very, very tough baseball player who stands very close to the plate to challenge the pitcher. If you do that, occasionally you get hit in the face with an inside fastball. That's the way the business works. So if I have invested some money in a copper porphyry in Argentina, and Mrs. Kirchner comes in and she changes things for 5 years, that's the breaks. The way that I participate in stocks where I get a 20 bagger or a 30 bagger or a 40 bagger is I take risks. And if you take risks, occasionally you will realize risks.
That's right. But really, in today's world, post Lehman Brothers, post 2008, post everything else that's gone off the charts since then, are we not all speculators? I mean, isn't it kind of speculative to bet on Wall Street?
Louis, that's such a good point. I mean, we are speculating by continuing to live in a society that is insane as the United States. The idea that lending money to the US government for 30 years isn't risky is insane. I'm not an economist, I'm a credit analyst. But when, and I don't know what the right number is, when people tell me that the on-balance sheet liabilities of the federal government are $16 trillion, growing by $1 trillion a year. You know, $1 trillion is a lot, Louis. That's, you know, when you do 16, there's 12 zeros after the 16. I mean, if you write 16 trillion, you're writing for a long time. And then the off-balance sheet liabilities, some people say it's 85 trillion, other people say it's 200 trillion. Whatever it is, it's a lot. The idea that an economy with a GDP of 15 trillion is somehow going to earn itself out of net present value of liabilities in the range of $100 trillion, and I am going to lend this society 30-year money for 350 basis points, that's hugely risky from my point of view. Jim Grant went so far as to call it return-free risk. And return-free risk doesn't sound particularly attractive to me.
Very good. Okay, we've covered a lot of ground. Any final thoughts for people today, in the markets today?
Yeah, absolutely. It is easy to be aggressive in periods like 2010 when your experience in the immediate past is pleasant. It's difficult to be aggressive after prices have fallen by 75%. But when you shop for goods that aren't financial goods, when you shop for household goods, when you shop for clothing, when you shop for food, you look for goods on sale. Goods are on sale. Don't pass it up. You may be early, But even being early, you will do better buying in 2012 than you did in 2010.
Okay, thank you very much.
Pleasure.